they beat consensus across the board. Record Q2 revenue of $591 million, up 3% year over year. Adjusted diluted EPS of 91 cents, up 17%. They newly initiated Q3 total company sales guidance of $580 million to $600 million, and the stock definitely caught a bid after the report.
Oh, it absolutely did. The market loved those headline numbers.
Yeah, so we are diving straight into Graco Inc.'s Q2 2026 earnings today. Acting as your financial analyst, we are pulling from the company's latest Form 10-Q, the earnings release, and that Q2 investor presentation, all hot off the presses from July 2026.
Right, and our mission for this deep dive is really to help you, the retail investor, cut through all the corporate jargon.
Exactly. We want to break down what is actually driving the financials of this century-old pump and fluid management company because, Graco is celebrating its centennial right now in 2026.
Which is pretty incredible in this industry.
It really is. But here's the real hook for today. We need to figure out how a 100-year-old company known for making traditional paint sprayers and industrial pumps is suddenly tying its future to Silicon Valley data centers.
Yeah, while simultaneously executing this massive $500 million shopping spree.
Right. So to understand that pivot, let's look at the mechanics driving those headline numbers. The top line beat looks great, but to really understand why earnings jumped 11% to $183 million, we have to look under the hood at their largest division.
Yeah, the contractor segment. Because the narrative management is presenting there is, well, it's pretty nuanced.
For sure. So that segment deals heavily with residential and commercial construction, providing the sprayers used by professional painters and DIYers, and the numbers look fantastic on the surface. Sales hit $299 million, which is a 4% increase.
Right, but the metric that really jumps off the page is the operating margin.
Oh, massive jump.
Yeah, it surged 400 basis points to hit 30%. And that level of margin expansion drove operating earnings in the contractor segment up 21%.
But, I want to push back on the organic demand story here for a second.
Okay, lay it out.
Management noted that contractors saw organic sales growth in the Americas in both the professional paint and home center channels for the first time in 2 years.
Right.
But given the broader macroeconomic environment, the high mortgage rates, people are locked into their homes, housing turnover is sluggish. How is Graco suddenly squeezing blood from a stone in DIY and professional paint?
Well, the organic growth story is really heavily reliant on the difference between new construction and renovation.
Oh, I see.
Yeah, so while new housing starts have been under a ton of pressure, the aging U.S. housing stock still requires continuous maintenance. Graco's products index heavily toward repair and remodel. Painting existing exteriors, upgrading insulation.
Right, so that keeps the baseline steady.
Exactly. The 3% organic sales growth in the Americas is a solid baseline. It means foot traffic is moving product off the shelves at home centers. But, as a retail investor, you have to separate top-line revenue growth from bottom-line profitability.
Because a 400 basis point margin expansion doesn't come purely from selling a slightly higher volume of paint sprayers?
No, definitely not. It comes from aggressive cost recovery. The real catalyst for that margin spike was a highly favorable regulatory tailwind.
Ah, the tariffs.
Exactly. Graco recognized a $9 million net favorable impact from tariffs company-wide this quarter. And out of that $9 million, a full $5 million landed directly in the contractor segment.
Which is huge. Let's unpack the mechanics of that tariff relief, actually, because it often gets glossed over in earnings calls as just a simple benefit.
Yeah, it gets buried in the notes.
Right. So when an industrial company like Graco imports raw materials like steel, aluminum, internal components, they're subject to Section 301 tariffs or a similar trade duty.
Right, which artificially inflates their cost of goods sold.
Exactly. It just compresses their gross margins for years. But when supply chains are rerouted or specific tariff exemptions are granted, that sudden cost reduction flows straight down to operating earnings.
Unencumbered. It acts as an immediate margin accelerant.
Yeah.
So you combine that $5 million tariff benefit with stabilized raw material inflation and tighter cost controls, and boom.
You get a 21% jump in earnings on only a 4% increase in sales.
Exactly. So the takeaway here is that top-line organic demand in the contractor segment is still relatively muted. The bottom-line explosion was heavily subsidized by regulatory cost relief.
Which really changes the tenor of the earnings beat. It's more about excellent cost management than explosive end-market demand.
Yeah, 100%.
And that struggle to find robust organic growth forces a company to look for alternative solutions. Which brings us to the industrial segment, where they're basically just going out and buying revenue.
Yeah, the industrial segment is a totally different playbook. Overall sales were up 3% to $249 million. but organic sales actually declined by 3%.
Right, meaning the revenue from their core existing business went down. I look at this dynamic like a starting pitcher struggling on the mound, right?
I like that analogy.
The organic growth of their traditional industrial equipment is giving up runs. It's lagging. So
Yeah.
management goes to the bullpen and brings in acquisitions to act as the relief pitcher to save the game.
That's a great way to frame it, because acquired operations contributed 5% to the industrial segment's sales this quarter.
Which perfectly masked that 3% organic drop.
Exactly. And management attributed that organic decline to the timing of finishing system sales.
Right.
We're talking about massive, capital-intensive equipment used in, like, automotive manufacturing.
Right. Long purchase cycles, highly sensitive to corporate borrowing costs.
Yeah, and the revenue recognition is inherently lumpy. When macroeconomic uncertainty hits, manufacturers delay upgrading their paint lines, and Graco's core revenue takes a hit.
So the acquisitions stepped in to fill the revenue gap, but they created a completely different problem on the margin side. Operating earnings for industrial only increased 2%.
Right, they didn't get anything close to that 400 basis point expansion we saw in contractor.
Why not? Didn't they get a tariff benefit there too?
They did, yeah.
Yeah.
They got $4 million in cost relief. But that $4 million simply offset the lower margin profile of the newly acquired businesses.
Because when you integrate a new company, you're absorbing overlapping overhead and redundant administrative costs.
Exactly. The acquired company rarely operates at the margin profile of the parent company on day one. So the acquisitions buy top-line revenue growth, but they actively dilute the segment's operating margin.
At least until management can optimize the assets and trim the fat.
Right, that integration drag keeps margins flat,
Yeah.
but, contrast that heavy cyclical struggle with their third division,
Yeah.
the expansion market segment.
Oh, this is where it gets really interesting. It's their smallest segment by far, right? Just $42 million in sales.
Yeah, tiny. But it achieved 3% organic growth and an incredible 23% operating margin, entirely on its own merit. No acquisitions masking the numbers.
And the CEO, Mark Sheehan, specifically called out investment in data center infrastructure and semiconductor strength here.
Which is such a pivot.
Right. When you picture Graco, you think of a heavy-duty sprayer on a construction site. You don't naturally jump to artificial intelligence or sterile server farms.
Well, the connection is in the fluid management engineering. Modern tech runs incredibly hot. High-performance AI servers can't be cooled by traditional HVAC systems anymore.
Oh, so they need liquid cooling.
Exactly. Complex liquid cooling loops circulating dielectric fluids directly to the server racks. And those systems need industrial-grade pumps and manifolds that have zero tolerance for leaks.
And Graco has a century of expertise in moving viscous fluids without leaking.
Bingo.
Yeah.
It translates perfectly. Same thing with semiconductor fabrication. Building a microchip requires dispensing highly corrosive chemicals at microscopic tolerances in a clean room.
Because a bad pump or an imprecise dispense ruins a wafer worth tens of thousands of dollars.
Right, so Graco isn't designing the microchips. They are providing the mission-critical plumbing.
For a retail investor, this expansion segment is a highly valuable diversification hedge. It decouples their growth from traditional industrial capex and ties it to massive secular tech trends.
Yeah, and the margins are robust.
So seeing how crucial M&A in these new markets are perfectly sets the stage for their biggest move this quarter. They went on a nearly $500 million shopping spree.
Yeah, their capital allocation strategy right now is aggressive. Through June 2026, they generated $298 million in operating cash flow.
And then they announced the definitive agreement to acquire Valco Melton for $447 million in cash, expected to close in Q3.
Right, but we really need to scrutinize how they are deploying all that capital.
Absolutely, because there is a massive disparity here. I'm looking at the cash flow statement. They spent $29 million on their own internal capital expenditures year to date, property, plant, equipment.
Right.
But they spent a staggering $331 million repurchasing 4.2 million shares of their own stock.
It's a huge gap.
They're spending over 10 times more on stock buybacks than on internal capex. So is this a signal that management thinks their stock is undervalued or a sign they lack organic investment ideas?
That is the central debate for mature industrial equities. But you have to remember, Graco's core manufacturing model is incredibly asset light.
Okay, so they aren't like a steel mill that needs billions just to keep the lights on.
Exactly. They project they only need about $90 to $100 million in total capex for the full year 2026, and that already includes a $50 million facility expansion.
So the core business just throws off way more cash than it needs.
Right, which gives them the luxury of optionality. They can fund a $447 million acquisition entirely with cash, maintain a $98 million dividend, and still retire millions of shares.
which artificially boosts the earnings per share for the remaining float. But let's focus on what that $447 million is actually buying with Valco Melton.
Yeah, so Valco Melton provides adhesive application systems. They generated roughly $145 million in revenue in 2025.
It's not just about adding $145 million to the top line.
No, it's all about the revenue mix. Valco Melton brings a roughly 50% aftermarket revenue mix.
Ah, the classic razor and blades model.
Exactly. Selling a massive adhesive system to a packaging facility is the razor, but that machine has a 15-year lifespan.
So the customer has to continuously purchase replacement nozzles, specialized hoses, and maintenance kits.
Right. Those are the blades. And this aftermarket model insulates their cash flow against macroeconomic downturns.
Because if the economy contracts, customers freeze their CapEx budgets. They stop buying new machines.
But they can't stop running their existing production lines. They actually over-index on maintaining their aging equipment. So that replacement part revenue remains highly predictable.
And crucially, the margin on aftermarket parts is exponentially higher than on the original equipment.
Exactly. So by integrating Valco Melton, Graco is shifting its corporate profile toward this recurring high-margin revenue model.
Which dampens the cyclicality of their legacy industrial exposure. Well, with that integration looming in Q3, retail investors also need to be aware of a major accounting shift Graco just initiated.
Yeah, this is really important for anyone reading their future earnings reports. Starting in Q2 2026, they updated their non-GAAP reporting methodology.
Right. They are now explicitly excluding acquisition costs and the amortization of acquired intangible assets from their adjusted earnings.
Which companies do to provide a, quote, consistent comparison of operating results.
Sure. Because when you make a $447 million acquisition, you incur huge, immediate cash outflows, investment banking fees, legal structuring.
And you're acquiring intangible assets like Valco Melton's customer lists and patents.
Right, and under standard accounting, the cost of those intangibles must be amortized, written off as an expense over several years, which reduces reported net income.
So by excluding it, management is basically arguing that amortization is just a non-cash accounting artifact that obscures the true cash-generating power of the business.
But this adjustment undeniably flatters the current financials. I mean, the reported GAAP diluted EPS was 90-some cents, up 14%. But the adjusted diluted EPS, stripping out M&A costs, was 91 cents, up 17%.
Right, and the danger for retail investors is taking that adjusted number at face value. Warren Buffett has historically been a huge critic of ignoring the amortization of intangibles.
Especially for companies whose growth strategy relies on acquisitions. The logic is you can't applaud management for driving top-line growth through M&A and then completely ignore the very real capital costs required to execute it.
Exactly. The premium paid for those intangibles was real cash. The banking fees were real dollars. Adjusting them out paints an overly optimistic picture of their total return on invested capital.
It forces investors to really monitor both the GAAP and non-GAAP figures going forward.
Yeah, you have to read the reconciliation tables in the SEC filings.
Good advice. So looking ahead, management laid out their full-year 2026 guidance. And despite the strong Q2 beat, the outlook is pretty conservative.
It is. They are projecting low single-digit organic revenue growth on a constant currency basis.
Right. They are factoring in some improving market conditions in the back half of the year, but they clearly aren't forecasting an explosive reacceleration of demand.
No, and that aligns in the data we've unpacked. The organic backlog is up 28% from year-end, which is a great leading indicator.
But as we discussed with the industrial segment, turning that backlog into realized revenue is still being hampered by delayed project timelines.
Exactly.
So as you synthesize all these moving parts, the tariff margins, the data center pivot, the massive buybacks, the accounting shifts, what is the larger strategic narrative here? Let's leave you with a larger strategic question to ponder.
Yeah, this is the big picture. We've established that organic growth is essentially flat to slightly negative in their core industrial markets.
Right, forcing them to lean heavily on acquisitions to show growth to Wall Street, while simultaneously deploying $500 million for a 50% aftermarket recurring revenue mix.
So the strategic question is, are we witnessing a fundamental evolution of the business model?
Is Graco quietly transitioning away from being a traditional organic equipment manufacturer and instead engineering itself into an industrial holding company?
One that depends on M&A, data center exposure, and recurring service revenue to drive shareholder value.
It is a profound pivot for a 100-year-old company. and it fundamentally alters how you need to model their future cash flows and their resilience in an economic downturn.
It's exactly the kind of structural shift you need to watch closely.
Absolutely. Well, be sure to follow the show for your daily, no nonsense earnings coverage so you never miss the underlying narrative hiding in the numbers.